stop checking the silver price on your phone, because if all you're watching right now is the New York ticker, then you're being misled. You see silver trading around $74.89. You notice the green candles. You see a sudden $3 jump and assume you understand what's happening. But you don't. What you're seeing isn't the real market. It's an illusion, a paper-driven derivative system that's being quietly crushed by a liquidity crisis unlike anything we've experienced in the last 40 years. If you want to see the real price of silver, the price that the world's largest industrial players are actually paying, then you need to stop looking at New York altogether. You need to shift your focus 5,000 miles east to Shanghai. Because right now, as we speak, the physical silver market in China is trading at a premium that translates to nearly $80 per ounce. That creates a $5 gap. $5. In global finance, a gap of just a few cents is considered a normal opportunity, but a $5 gap is something else entirely. It signals a system failure. It means the arbitrage mechanism, the process that normally keeps prices aligned across the world, has broken down. It means silver is moving in only one direction. And it means the price in New York has no alternative but to reprice sharply higher in order to close that gap. Today is Boxing Day, Friday, December 26th. On paper, the markets are open. In reality, the people who normally control them are gone. We are now inside what traders call Ghost Week. Senior traders are away. Risk managers are offline. And automated systems are left operating on their own inside an environment where liquidity has almost completely disappeared. In this investigation, we're going to lay out exactly what's happening inside the market on December 26th. We'll break down the mathematics behind the Shanghai spread. We'll explain why U.S. bullion dealers have either frozen sales entirely or raised premiums as high as $90, simply because they cannot source replacement metal. And we'll examine the gamma wall sitting at $75. We are extremely close to it. If that level breaks in this thin holiday market, the move from $75 to $80 won't take days. It could happen in minutes. The paper price is failing. The physical market is taking control. This is the story of the $80 squeeze. To understand why this is unfolding today, of all days, you have to understand the calendar itself. Wall Street is ultimately run by people. And the final week of December is the one time each year when those people disappear. This period is known as Ghost Week. Trading desks at major banks are operating with skeleton crews, junior traders, interns, and passive algorithms. The deep pool of buy and sell orders that normally absorbs volatility has evaporated. Picture a swimming pool. When it's full, you can jump in and barely cause a ripple. That's a liquid market. But today, the pool is empty. Pour in even a small bucket of water, and it splashes everywhere. That's the market we're in now. Earlier today, a single large buy order slammed into the silver market and sent the price straight from $71 to $74.89, a $3 move in a clean vertical line. Why did it happen? Because there were no sellers. The ask side of the order book was empty. The banks weren't there to defend the price or absorb the impact. With no resistance, the price simply jumped. This is both the danger and the opportunity of Ghost Week, when a determined buyer, whether a Chinese industrial player or a stressed hedge fund, steps into a market like this. They meet almost zero opposition. Prices can rise 5 or even 10% with barely any effort. What we're watching is a vacuum melt-up. And the most important part is that the buying hasn't stopped. The algorithms see an empty room, and they're rushing for the door. So what triggered this sudden rush? Why would buyers panic the day after Christmas? The answer is China. While the US market was closed for the holiday, trading continued in Asia. And in China, the pressure is obvious. Solar manufacturers are scrambling to lock in silver paste before year-end. Battery producers are building inventory. That surge in demand pushed prices on the Shanghai exchange to around 595 yuan per gram. Converted into dollars and ounces, that works out to roughly $77.20. But that's only the exchange price. Once you factor in VAT and the physical delivery premiums being charged on the streets of Shenzhen, the true cost of getting silver into your hands in China is already above $80 per ounce. That price difference creates the perfect arbitrage. You buy silver in New York at roughly $75 and sell it in Shanghai near $80, locking in $5 with virtually no risk. That trade acts like a powerful magnet. It pulls every available bar of silver out of London and New York vaults, loads it onto planes, and sends it east. As metal drains from the west, a physical shortage forms, and when supply tightens, prices have to rise, either to destroy demand or attract new supply. At $75, the outflow doesn't stop. Even $78 may not be enough. New York has to move toward $80 simply to slow the bleeding. That's why the current price doesn't reflect a healthy market. A price near $74 suggests stability, but a $5 global spread reveals a broken supply chain. The market is trying to repair itself by repricing silver higher. Now look at what's happening on the ground in the United States. You might glance at your screen and think, great, I'll buy silver at $74. Try it. Visit a major bullion dealer right now. Check Silver Eagles. Check 100-ounce bars. You'll usually see one of two outcomes. Either the product is out of stock, or it's listed for pre-order with delivery pushed into late January. And if metal is available, look at the price. Eagles are selling near $90. Generic bars are closer to $82. That isn't simple greed. It's fear. Dealers are terrified of replacement cost. If they sell a coin today at $78 and the market gaps to $80 on Monday, they can't restock without taking a loss. With volatility this extreme during Ghost Week, dealers widen spreads to protect themselves. In effect, they're saying, we don't want to sell. That's confirmation of a liquidity crisis. It's not just paper liquidity that's gone. Physical liquidity is disappearing too. Metal is being hidden. Holders aren't selling, miners are holding back, refiners are shut for the holidays. You're left with desperate buyers and almost no sellers, and that's how charts turn vertical. We're now sitting right below the gamma wall at $75. The market is trading around $74.89, just 11 cents away from a critical trigger. In the options market, $75 is a massive strike. Banks have sold call options tied to millions of ounces at that level. As price approaches it, those banks flip into negative gamma. That means they're short volatility. To protect themselves, they're forced to buy futures contracts. And the higher the price climbs, the more they're required to buy. It becomes a self-reinforcing loop. If silver pushes through $75, bank algorithms automatically kick off another wave of buying. That buying lifts the price higher, which forces even more buying. In a thin holiday market, this kind of gamma squeeze can accelerate fast. With no human traders around to sell into the move, algorithms end up chasing each other higher. A run towards $78 in a single session becomes entirely possible once $75 gives way. But there's an important warning that comes with this setup. When liquidity is this thin, the market can be pushed in either direction. Even in a strong uptrend, a single large sell order can knock the price down $2 or $3 in seconds. That's known as a rug pull. Banks may attempt exactly that, dumping size to trigger stop losses and flush out leveraged positions. If you see silver drop $2 in a minute, that doesn't mean the story has changed. It isn't a fundamental shift. It's structural. It's simply a large player splashing around in a very shallow pool. The core reality hasn't moved. Silver is still trading near $80 in China. Any sudden dip is just noise. And for sophisticated money, it becomes another arbitrage opportunity rather than a reason to panic. As the clock approaches 1 p.m. and markets shut down for the weekend, the next phase begins. We're about to enter another 48-hour vacuum, followed by the Sunday night reopen. If Shanghai opens higher again, if prices there push toward $82, New York will be forced to gap up when trading resumes. The market is chasing a moving target. This is what real price discovery looks like. The old $25 price was an illusion. $75 represents awakening, and $100 is where this trajectory points. But getting there won't be smooth. The volatility over the coming days will be intense. Swings large enough to wipe out leveraged traders in seconds are likely. That's why this environment favors physical ownership or fully unleveraged positions. You can't stay mounted on a bucking bronco if you're over-leveraged. You'll get thrown off. Now look ahead to the calendar. We're just 3 trading days away from the new year, and funds are watching closely. If silver finishes the year near all-time highs, momentum models for 2026 will activate. Pension funds will scan the list of top-performing assets from 2025, and silver will be sitting at the top. Capital allocations will follow. Billions of dollars of new money will pour into an already tiny market during the first week of January. That's why the move to $75 isn't the finale, it's the warm-up. The real volume arrives next week, and if silver is already near $80 in China without pension participation, the upside once that capital enters becomes obvious. This isn't the moment to exit. The main event hasn't even started yet. While everyone is fixated on silver at $75, the most important signal is being overlooked: gold. Gold is trading around $4,500, and that price acts as the anchor for the entire precious metals complex. If silver feels expensive at $75, it's because you're measuring it in dollars instead of measuring it against gold. Run the ratio. Divide $4,500 by $75 and you get 60. It currently takes 60 ounces of silver to buy 1 ounce of gold. Historically, that number is still extremely elevated. In 1980, the ratio collapsed to 17 to 1. In 2011, it reached 30 to 1. From a geological standpoint, it's closer to 8 to 1. Even after this vertical rally, silver remains deeply undervalued relative to gold. That's why experienced capital isn't selling. They see significant upside simply from a return toward historical norms. If the ratio moves back to 30 while gold stays near $4,500, silver reaches $150. That's the math driving algorithmic demand. Silver isn't being bought out of emotion. It's being accumulated because it's mispriced beta relative to gold, and that relationship creates a powerful secondary floor under the market. Now return to the dealer freeze and look at how the plumbing actually works. When a dealer sells you a physical ounce of silver, they normally hedge that sale in the paper market to lock in price risk. Under normal conditions, that system functions smoothly, but during Ghost Week, the paper market becomes thin, spreads widen, and hedging becomes dangerous. Dealers trying to hedge get punished on price, driving hedging costs sharply higher. Those costs are then passed on to buyers through higher premiums. But the bigger issue is settlement risk. If a dealer hedges through a futures exchange, and that exchange halts trading or declares force majeure, the hedge becomes worthless. The dealer is left exposed. In a liquidity crisis, dealers stop trusting the paper market to protect them, and when they can't hedge, they can't sell. Inventory becomes too valuable to release. That's why buy buttons disappear. It's not a conspiracy, it's survival. The financial infrastructure that allows retail buyers to access silver is clogging up, pushing the market toward a system where physical access depends on direct relationships rather than open exchanges. We're now watching a major transfer of wealth unfold. Capital is moving out of paper assets and into tangible ones. For decades, the winning strategy was owning bonds and stocks, financial promises backed by future payments. But with U.S. debt sitting around $36 trillion and interest costs consuming government revenue, those promises are breaking down. The only way that debt gets managed is through money creation. Inflation becomes the default. As a result, capital is fleeing the bond market, a structure that's effectively on fire, and searching for something that can't be printed. That destination is commodities. The global bond market is roughly $100 trillion. If just 1% of that capital attempts to escape, that's $1 trillion looking for safety. Meanwhile, the entire investable silver market is worth less than $300 billion at current prices. You can't force $1 trillion into a container that small without expanding it. The only way it expands is through higher prices. This isn't ideology, It's math. For silver to absorb that capital, it has to grow into a trillion-dollar asset class, which implies prices far above current levels. This shift also explains a psychological phenomenon we touched on earlier, the Evelyn Good effect. Under normal conditions, rising prices suppress demand, but during a currency crisis, the opposite happens. When people watch silver rise $3 a day, they don't see it as expensive. They see it as protection. They notice groceries getting pricier. They watch their cash lose purchasing power. At the same time, they see silver rising on their screens. The higher it goes, the more desirable it becomes. It turns into a signal, proof that someone exited fiat at the right time. That feedback loop fuels the early stages of mania. And that's exactly where we are now, still in the foothills. When your Uber driver starts asking about silver, that's when the cycle ends. Right now, they're still complaining about gas prices. That tells you we're early. Now let's look at the mechanics of the short squeeze that's building beneath the surface. We've talked about banks being trapped. But which ones? The pressure is on the commercial traders, bullion banks and swap dealers, the entities that normally act as the house in the casino. Under most conditions, the house always wins. They have time, capital, and patience. But this time is different. They're positioned against physical supply at the exact moment that supply is disappearing. That's why we're seeing backwardation emerge. Normally, futures prices trade above spot prices because storage and financing costs need to be covered. That's contango. But right now, particularly in Shanghai and at times in New York, spot prices are higher than futures prices. That's an alarm bell. It tells the market that immediate delivery is more valuable than future promises. Buyers are effectively saying, I don't want silver next month. I want it now and I'll pay extra for it. Backwardation during a rally confirms a genuine shortage. It signals that the squeeze isn't speculative, it's structural. Shorts can't roll positions forward without taking losses, so they're forced to buy. And in a market this illiquid, that buying creates the sudden air pockets and price jumps showing up on the chart. That brings us to the geopolitical dimension of the gap. Why is China willing to pay $80 for silver? Solar and batteries explain part of it, but there's a bigger strategy at work: de-dollarization. China is actively working to weaken the dominance of the US dollar, and one way to do that is by securing control over strategic commodities. If China dominates the silver market, a metal critical for advanced weapon systems, satellites, and green energy, it gains leverage over the pace of Western technological development. By paying elevated prices, China is draining physical silver from Western inventories. It's an economic maneuver, not speculation. They're exchanging surplus paper dollars for a hard, strategic asset they need. That bid isn't temporary, it's policy-driven. Meanwhile, the US is allowing metal to flow out unchecked. At some point, export restrictions may appear. But until that happens, the arbitrage window stays open, and prices will continue rising until New York is forced to match Shanghai. Mining stocks tell a different story, and that's exactly why they matter. Some have moved higher, but many are still lagging badly. This isn't because the fundamentals are weak, it's because investors are afraid of a broader market sell-off, so they dump everything, including precious metal equities. That fear is creating an opportunity. At $75 silver, many mining companies are trading at 1 to 2 times free cash flow. That's extraordinarily cheap. Once broader markets stabilize, or once generalist investors recognize how much cash these companies are generating, capital will rotate. Money will move out of big tech and into miners. Nvidia gets sold. Hekla gets bought. Tesla gets sold. First Majestic gets bought. That rotation hasn't fully begun yet. When it does, mining stocks can double in a matter of days. For anyone who missed the move in physical silver, miners represent the second chance trade, leveraged exposure to the $80 thesis. Now consider where we are on the calendar. There are only 3 trading days left in the year. Banks want to push prices lower into year end. Funds want to mark prices higher. In the end, volume decides. And right now, buying pressure outweighs selling. Even with skeleton crews in place, buyers are more aggressive than sellers. That increases the odds of closing the year near all-time highs. Technically, that would leave behind a monthly candle that looks like a green skyscraper, a pattern that historically points to continuation in January. There's no overhead resistance. The chart is open sky. Everything points higher. Could something derail it? Possibly. The Fed could step in. Margins could be raised. Trading could even be halted. But those are systemic responses, not fundamental changes. They're signs of a stressed system trying to defend itself. And even if trading were halted at $75, the real-world price wouldn't stop. It would simply move off exchange. You can't cool the temperature by smashing the thermometer. The pressure remains. So as we move into the weekend and look ahead to Monday, December 29th, the strategy doesn't change. Don't sell physical metal. Don't get sucked into short-term noise. Watch Shanghai. As long as Shanghai leads, the trend remains intact. The liquidity crisis isn't easing, it's intensifying. As New Year's Eve approaches, liquidity thins even further. One final spike before the year turns is entirely possible. Silver opening 2026 near $80 isn't fantasy. It's consistent with the trajectory already in motion. What we're witnessing is a transfer of wealth, from impatient hands to patient ones, from paper claims to physical assets, from west to east. The squeeze isn't over. It's only just beginning. Hold the line.